In the summer of 1997, one of the fastest-growing regions in human history dropped off a cliff. Currencies collapsed, stock markets crumbled. Banks that had been printing money for a decade suddenly couldn't cover their own debts. In just a few months, hundreds of billions of dollars in wealth evaporated across Southeast Asia, and millions of people who had been climbing into the middle class were shoved right back into poverty. Thailand, Indonesia, South Korea, Malaysia, the Philippines, countries that had been called the next great success story of global capitalism, were on their knees, begging the IMF for a lifeboat. And here's the wild part. Just months earlier, the World Bank had published a glowing report calling this region the East Asian miracle. Economists, investors, and journalists all agreed. Asia was the future. Growth was permanent. The money fountain would never stop flowing. But what exactly caused the miracle to shatter? How did the world's most celebrated economies go from double-digit growth to full-blown financial catastrophe in the span of a single summer? Was it greed? Bad policy? A rigged global system? Or was the miracle itself a mirage all along? Let's rewind to the early 1960s and trace how a group of poor, war-torn countries built one of the most staggering economic booms in modern history, and how the very forces that lifted them up eventually pulled them under. Buckle up, because this one has all the ingredients. Cheap money, political favors, foreign speculators, hidden debts, and a currency peg that was quietly ticking like a bomb. In 1960, most of Southeast Asia was desperately poor. Thailand's average income was on par with parts of sub-Saharan Africa. South Korea was recovering from a devastating war that had leveled its cities. Indonesia was politically unstable and heavily dependent on raw commodities. Malaysia had just gained independence. On paper, none of these countries looked like they were about to become global powerhouses. Yet within 30 years, they would. And the transformation would be so complete that economists needed a new word for it. The playbook was simple, at least in theory. Cheap labor, export-led growth, and a lot of help from friends abroad. Governments across the region built factories, subsidized industries, and pegged their currencies loosely to the US dollar to make trade predictable. Foreign companies, especially Japanese and American ones, poured in to take advantage of low wages and disciplined workforces. Textiles, electronics, cars, shipbuilding, everything was made in Asia, and the world couldn't get enough of it. South Korea went from producing wigs and plywood in the 1960s to building Hyundai cars and Samsung semiconductors by the 1980s. Thailand became a hub for hard drives and auto parts. Indonesia leveraged its oil and turned it into infrastructure. Malaysia poured billions into palm oil, rubber, and high-tech manufacturing. Growth rates that would make a Western economist weep became normal. 7%, 8%, sometimes 9 or 10. Year after year, decade. By the early 1990s, the region was on top of the world. Bangkok was covered in construction cranes. Seoul had transformed into a gleaming skyline of chaebol headquarters. Kuala Lumpur was building the tallest towers on the planet. Jakarta was minting new millionaires by the week. Foreign investors couldn't wire money in fast enough. Between 1990 and 1990s, private capital flows into these 5 countries topped $220 billion, an amount that would have been unthinkable a decade earlier. Everyone wanted in on the miracle. And why wouldn't they? The returns were spectacular, the governments were friendly, and the growth looked unstoppable. But underneath the shining towers and the glowing headlines, something was quietly rotting, and almost nobody wanted to talk about it. The problem started with the currency pegs. To keep their economies stable and attractive to foreign investors, countries like Thailand, Malaysia, Indonesia, and the Philippines had loosely tied their currencies to the US dollar. It made sense on paper. A stable exchange rate meant foreign lenders could pour money in without worrying about currency risk. And boy, did they pour money in. Between 1990 and 1996, foreign banks lent hundreds of billions to Southeast Asian companies, often in short-term dollar-denominated loans. Real estate developers, industrial conglomerates, banks, and even government-linked firms borrowed cheaply from overseas and invested it locally at much higher returns. It was free money until it wasn't, because here's what nobody was paying attention to. A lot of that borrowed money wasn't going into productive investments. It was going into real estate speculation, vanity projects, overbuilt factories that produced things nobody wanted, Bangkok office towers that sat empty, Jakarta luxury condos built for buyers who didn't exist, Malaysian infrastructure schemes with murky financing. In South Korea, the giant chaebol conglomerates were building empires on debt, expanding into industries they didn't understand, and being propped up by cozy relationships with domestic banks that couldn't say no. Debt-to-equity ratios at Korean firms climbed to over 400%, in some cases over 500%. These weren't companies. They were leveraged bets held together by political favors and blind optimism. The banks weren't much better. Many were undercapitalized, poorly regulated, and stuffed with bad loans that were papered over year after year. Regulators looked the other way because growth was so good and everyone was getting rich. Crony capitalism, some economists called it later. The nice version. The unvarnished version was that the entire region had built a giant credit bubble on a shaky foundation, and it only worked as long as foreign money kept flowing in and the currency pegs held. Two things that would soon be tested. Then in 1995, something happened halfway across the world that would light the fuse. The US dollar started to rise sharply against the Japanese yen. Because Southeast Asian currencies were tied to the dollar, they rose too. Suddenly, Thai and Malaysian exports became more expensive on world markets. Growth in exports slowed. Trade deficits widened. Meanwhile, China had spent the early 1990s devaluing its own currency and becoming an export monster, undercutting the same industries that had made Southeast Asia rich. The competitive advantage the region had built for 30 years started slipping away, and still, the borrowing continued. Still, the towers went up. Still, the party raged on. By early 1997, the smart money was starting to notice. Hedge funds and currency traders began quietly betting that the Thai baht was overvalued. They looked at Thailand's current account deficit, ballooning short-term dollar debt, and shaky banking sector, and they concluded that the peg couldn't hold. Speculators started shorting the baht in massive quantities. The Bank of Thailand fought back the way central banks always do, by spending its foreign currency reserves to defend the exchange rate. Billions of dollars were burned through in weeks, but there was no bottom. On July 2, 1997, Thailand's central bank finally raised the white flag and let the baht float. Within hours, the currency plunged. Within days, it had lost roughly a quarter of its value. Within months, more than half. And then the panic went regional, because if Thailand could fall, so could everyone else. The contagion spread like wildfire. Investors who had been dumping money into the region for years suddenly wanted out. All at once, the Philippine peso fell, the Malaysian ringgit fell, the Indonesian rupiah fell so hard it became one of the worst currency collapses in modern history, dropping by more than 80% against the dollar by 1998. And then, in November of 1997, the crisis jumped to South Korea, the 11th largest economy in the world. Nobody had seen that coming. Korea wasn't supposed to be vulnerable. It was industrialized, export-strong, and politically stable. But the chaebol debt bomb detonated anyway. Foreign banks refused to roll over short-term loans. Korean firms had no dollars to repay. The one collapsed, and a country that had just joined the OECD had to go begging for the biggest IMF bailout in history at the time, a staggering $58 billion rescue package. What followed was carnage. Companies that had been considered untouchable went bankrupt overnight. Daewoo, one of Korea's biggest conglomerates, would eventually collapse under $80 billion in debt. Indonesian firms defaulted en masse. Thai banks failed by the dozen. Millions of people lost their jobs. In Indonesia, the poverty rate more than doubled in a single year. Riots broke out in Jakarta. Suharto, the strongman who had ruled Indonesia for 31 years, was forced from power in May 1998 after mass protests over food prices and unemployment. The financial crisis had become a political crisis, a social crisis, a human tragedy. Life savings evaporated. Small businesses shuttered. Retirees who had trusted the miracle found themselves broke. The middle class that had been built over 3 decades was shredded in 12 months. The IMF stepped in with massive rescue packages for Thailand, Indonesia, and South Korea, totaling over $110 billion. But the medicine came with strings attached. Harsh strings. In exchange for the money, the IMF demanded painful austerity, high interest rates, and structural reforms. Governments had to cut spending. Banks had to close. Bankrupt firms had to be allowed to actually go bankrupt. Interest rates were jacked up to defend currencies, which crushed already struggling businesses. Critics argued the IMF made the crisis worse, not better, by treating a liquidity panic like an insolvency problem and squeezing economies that needed oxygen. Even the IMF, years later, would quietly admit it may have overreached. But at the time, there was no alternative. The choice, as one Korean official put it, was between bitter medicine and no medicine at all. So what lessons did the world take from the wreckage? First, that fixed exchange rates in a world of massive capital flows are essentially a slow-motion time bomb. When your currency is pegged and money can move in and out freely, you're basically daring speculators to attack you, and eventually they will. Most affected countries moved to floating or managed exchange rates afterward. Second, that short-term dollar debt is a poison pill for emerging economies. When your liabilities are in a currency you can't print, and they mature faster than you can earn dollars, you're one bad headline away from disaster. Countries across Asia dramatically restructured their debt profiles in the years that followed. Third, that transparency, regulation, and boring old accounting matter more than any glamorous growth number. Crony capitalism had hidden the risks for years. In the recovery, banking supervision was rebuilt from the ground up. Corporate governance was reformed, and the cozy triangle of politicians, bankers, and industrialists was pulled apart, though never completely. And finally, that miracles are almost never as miraculous as they look. Beneath every double-digit growth story is a set of assumptions that eventually gets tested, sometimes brutally. The remarkable thing is that Asia came back. South Korea rebuilt its economy into a global tech powerhouse. Thailand and Malaysia recovered and modernized. Indonesia eventually stabilized and became one of the largest emerging economies in the world. The region also built up massive foreign currency reserves as a kind of insurance policy, essentially saying never again. When the global financial crisis hit in 2008, Asia was actually better prepared than the West, which is a wild twist when you think about it. The students had become the teachers, but 1990 still lingers. It remains one of the clearest warnings in modern economic history about what happens when cheap credit, weak oversight, and blind optimism run together for too long. The miracle was real, in a sense. Millions of people really did rise out of poverty. Real factories were built. Real industries were created. But the last few years of the boom were a mirage layered on top of that reality. And when the mirage cracked, it took the miracle down with it, at least for a while. In the end, it was greed, complacency, and a stubborn belief that this time was different that turned the East Asian miracle into the East Asian crisis, a story as old as economics itself, dressed up in new towers and new currencies. And there you have it. The Asian financial crisis of 1997, one of the most dramatic and instructive collapses in modern economic history. If you enjoyed this video, be sure to hit the like button and subscribe for more deep dives into the moments that shaped the global economy. Comment your thoughts down below. Do you think another crisis like 1997 could happen today, or have we finally learned our lesson? And if you want to see how another so-called economic miracle turned into a decades-long slow-motion collapse, click the thumbnail on your screen for our video on Japan's lost decades. Trust me, you won't want to miss it. We'll see you guys next time.